Hey everybody, Professor D'Souza here with a quick intro and sort of overview looking at Chapter 1, Homework Problem Number 1. Okay, it deals with a taxpayer named Chuck, and we're given two very simple facts about Chuck's income. Okay, he's got what we're being told is taxable income of $75,000 and then bond interest of $10,000 for total income of $85,000. Now, we have not yet gotten into detail on some of this. So if you read ahead in the text, or if you kind of, sought for some of the information in the text while you're going through the problems, that's excellent. If you didn't, no problem. What I want to be doing each chapter is making sure that you're well grounded in the homework with problems like this. Now, one thing to note, okay, and this is one of the tax concepts that's sort of implied here or kind of layered into the problem, is that this bond interest is town bond interest. Okay, we're told this is the city of Heflin, I believe, and we'll see it in just a moment in the next video with the actual, when we actually look at to solve the problem. The tax rules tell us, and you don't know this yet, but you're going to learn it as we move forward in the course. Bond interest. Okay, now bond interest. Let's think about what that is. He owns a bond, so he's helping fund the city, okay, this town bond, and therefore he's earning a little bit of interest because he has purchased the bond. Okay, so we're referring a little bit back to financial principles 2 and some of your intermediate accounting. Okay, so this is income to him. He owns a financial instrument, now it's paying him income. The source of the bond matters, and here's why. U.S. tax law tells us that if you own a municipal bond, which is what this is, the interest is excluded from income, meaning Chuck does not have to include this in his taxable income when he computes his federal tax, okay? So for federal tax purposes, we're going to ignore the bond interest, and we're only going to have to compute his federal tax liability on the $75,000, okay? That's a starting premise with this problem. It's new, so I want you to take stock of that, this is not something, like I said, that you would know unless I told you or unless you read it in the book. What we have gone over is the fact that we do have income and we have to go to this U.S. federal tax rate, the brackets, and that's provided in the problem. You can click on the link and it'll take you to the brackets, and you're asked to do some short abbreviated math similar to the exercise we did last week, okay? So we're going to do that next, but I wanted to make sure this was an understood sort of concept. And this is basically, this is called an exclusion, okay? We'll be looking more at exclusions coming up in the course, okay? We have a whole chapter looking at exclusions and kind of what they are and how they work, and we'll look at the tax code that relates to exclusions. But just know that that's what's happening here, and the idea is that it doesn't even show up in his taxable income, okay? The IRS says you don't have to include it. Now, a question I'm going to ask in class I'd like for each of you to think about is, why would the IRS do this? And why would Congress do this, I should say, because Congress is the one who creates these rules. Why does Congress allow taxpayers to own municipal bonds and then receive that bond interest income and not have to pay tax on it? Think about that, and we'll talk about it in class. Meanwhile, I'll see you on the next video where we'll actually look at the problem. Okay? Thanks.